Europe's financial system has been thrown into chaos. In a move described by Bloomberg as a geopolitical earthquake, China has abruptly cut off multiple European banks from access to critical payment networks, citing retaliation against both Washington's escalating tariff war and Brussels' alignment with U.S. trade policies. The shock came less than 48 hours after former President Donald Trump announced a $750 billion tariff package targeting Chinese exports, calling it the only way to stop Beijing's economic aggression. But insiders in Beijing tell South China Morning Post that Chinese leadership saw Europe's quiet support for Washington as a direct provocation and decided to respond with unprecedented force. According to leaked documents from China's Ministry of Commerce, senior officials have been planning this financial counterstrike for weeks. Closed-door meetings in Beijing reportedly involved representatives from the People's Bank of China, the Ministry of Foreign Affairs, and state-owned financial giants. Their conclusion: if the West wants a trade war, Beijing will take the fight into the heart of its financial system. The first targets were European banks heavily exposed to Chinese markets, institutions in Germany, France, and Italy that handle billions in trade financing every year. Sources cited by Financial Times confirmed that Chinese regulators suspended certain transaction clearances and tightened compliance requirements so severely that some European lenders effectively cannot process payments for Chinese clients. This is economic warfare by other means, said one EU diplomat, speaking anonymously to Politico. Europe woke up to find its banks locked out of parts of the Chinese financial system, and now billions in trade deals hang in the balance. The scale of disruption is staggering. European manufacturers rely heavily on Chinese markets for everything from car parts to advanced electronics. With banking channels restricted, shipments are stalled at ports, exporters can't get paid, and supply chains across the continent are grinding to a halt. Meanwhile, in Washington, Trump doubled down on his tariffs, telling supporters in Ohio that Europe must choose between American freedom and Chinese tyranny. Analysts at the Brookings Institution say this rhetoric leaves Brussels trapped between two economic giants, punished by Beijing on one side, pressured by Washington on the other. Stock markets in Frankfurt, Paris, and Milan plunged on the news, wiping out over $250 billion in market value within hours. The euro fell sharply against the dollar, and yuan as traders feared a looming financial crisis. As one veteran banker told Reuters, "This isn't just about tariffs anymore. It's about weaponizing finance itself." And Europe is caught in the crossfire. The fallout from Beijing's sudden move reached Washington within hours, triggering panic inside the White House and Congress. According to Politico, senior officials from the Treasury Department, the U.S. Trade Representative's Office, and the State Department held a series of emergency calls with European leaders, urging them to stand firm against Beijing's economic coercion. But behind the scenes, Reuters reports, there were deep divisions inside Washington. Some advisors pushed for even harsher tariffs on Chinese imports, arguing that Beijing must pay a price for targeting Western financial institutions. Others warned that escalating too far could trigger a global banking crisis with consequences far beyond trade. President Trump, speaking at a rally in Iowa, was characteristically defiant. He accused China of economic blackmail and declared that his $750 billion tariffs would remain until Beijing plays by American rules. At the same time, he hinted that Europe had failed to pull its weight in confronting China, accusing Brussels of profiting from U.S. security guarantees while staying neutral in America's trade battles. For European leaders, the situation is rapidly becoming a nightmare. Brussels now faces financial retaliation from Beijing while absorbing the economic shockwaves of Trump's tariff war. European central bank officials told Financial Times they fear the banking restrictions could tip several EU economies, already weakened by high energy prices and slow growth, toward recession. French President Emmanuel Macron and German Chancellor Olaf Scholz held an emergency EU summit in Brussels, urging unity. But divisions quickly surfaced. Southern European nations, heavily reliant on Chinese trade and investment, demanded immediate negotiations with Beijing to restore financial links. Northern states, closer to Washington politically, insisted the EU must not reward Chinese aggression. Meanwhile, Wall Street analysts warn that European debt markets are under severe strain. Bond yields in Italy and Spain have spiked as investors fear defaults if trade disruptions drag on. The euro continues to weaken, adding to inflation pressures across the continent. At the same time, Beijing has shown no sign of backing down. Chinese state media openly mocked Europe's dependence on foreign powers, claiming Brussels was learning the hard way that aligning with Washington comes at a cost. Experts at the Brookings Institution argue that China's strategy is clear: punish Europe economically to break the transatlantic alliance, isolating the U.S. in its trade war, while pulling EU nations toward a more neutral stance. As one senior European diplomat told The Guardian, "We are caught between Washington's tariffs and Beijing's financial weapons. Every option looks bad, and time is running out." As the U.S., Europe, and China dig in, financial markets worldwide are plunging deeper into crisis mode. According to Bloomberg, global stock exchanges have lost more than $3 trillion in value since Beijing cut off EU banks last week, with investors fleeing to gold and U.S. Treasury bonds amid fears of a global recession. The International Monetary Fund has issued a stark warning, urging all sides to de-escalate immediately, citing projections that a full-blown trade and financial war could slash global growth by more than 2% this year alone. The IMF's chief economist called the standoff the gravest threat to global stability since the 2008 financial crisis. Energy markets are particularly rattled, with European banks unable to process payments for some Chinese suppliers. Oil and natural gas shipments have been delayed or rerouted, sending energy prices skyrocketing across the continent. Analysts at Energy Intelligence warn that if disruptions continue, Europe could face rolling blackouts and fuel rationing this winter. Meanwhile, the U.S. agriculture and manufacturing sectors are feeling the pain. China, the world's largest importer of soybeans, corn, and industrial machinery, has slashed orders from American suppliers, leaving Midwest farmers and factory owners facing devastating losses. The American Farm Bureau Federation warned this week that family farms are on the front lines of a geopolitical war they did not start. In Europe, protests have erupted in Berlin, Paris, and Madrid as businesses demand urgent action to restore trade flows. Truckers, factory workers, and farmers have blocked highways, accusing EU leaders of allowing Washington and Beijing to drag Europe into a war that threatens millions of jobs. Diplomatic efforts, however, remain deadlocked. Sources told Financial Times that secret talks between EU and Chinese negotiators collapsed after Beijing demanded the EU publicly oppose Trump's tariffs as a condition for lifting banking restrictions, a demand Brussels refuses to meet for fear of fracturing its alliance with Washington. Experts at the Carnegie Endowment for International Peace warn that the world may now be entering a new economic Cold War, with rival trade blocs forming around Washington and Beijing. Supply chains that once spanned continents are rapidly splitting along geopolitical lines, threatening decades of globalization. As one senior analyst told The Guardian, this isn't just a trade dispute anymore. It's the birth of a divided world economy, one half tied to the dollar, the other to China's financial system. The era of global economic integration may be over. For now, the question haunting policymakers and markets alike is simple. Can anyone stop this spiral before it triggers a global depression?